Today, central planners double down on beating inflation, but hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, remember when the mantra from central bankers was that inflation was temporary? This was still being recited late last year, despite the rapidly expanding money supply created by the reaction to COVID, which, by the way, had already been expanded by the reaction to the GFC in 2007 and beyond. Ultra-low interest rates were coupled with excessive government fiscal support, from direct payments to businesses and households, and indirect support to businesses as well. This combined stoked home prices and credit growth in an attempt to maximise employment, and also sheeted inflation mainly to supply chain disruptions, which would sort themselves out later. RBA Governor Lowe late last year said no rate rise until 2024, and only recently started to change his tune. But fast forward just 6 months, and the tone has completely changed, with a bevy of the world's top central bankers delivering a stern and unified message on the need to curb inflation, declaring at Jackson Hole that it was broad-based, here to stay, and will require their forceful action. Like lemmings, they are now all running off to the must-kill-off rampant inflation at all costs exit instead. Which sort of begs the question, were they wrong then, or are they wrong now? And while they plan to lift rates significantly higher, will it actually tame inflation or not? And what collateral damage will these rate increases cause? Frankly, I for one have very little confidence in the whole central planners and bankers edifice. They are, of course, unaccountable and unelected. So today I want to look firstly at the data that's out there, and secondly what they said. We know that housing markets around the world are slowing down drastically, underscoring a sector that's highly sensitive to interest rate increases. Pending and new home sales fell in the US in July to multi-year lows, while the slump in Australia is raising the risk of a recession. Home values in London are flat or falling in almost half of the city's boroughs, and the property downturn in China is testing whether the central bank can stick to its stimulus-light strategy. Key measures of US growth diverged in the first half of the year, and inflation-adjusted spending rose at a sluggish pace last month, even while Americans got some relief on prices, indicating the economy is feeling the pinch from the highest inflation in a generation. Even though the Fed's headline inflation figure eased, wages and salaries rose a robust 0.8% in July, which may spur further concerns about inflation becoming entrenched in the economy. The government's main measures of US growth pointed in different directions in the first half of 2022, adding to the ongoing debate on the health of the economy. Inflation-adjusted GDP, or the total value of all goods and services produced in the economy, decreased at a 0.6 percentage point annualized rate in the April to June period. But the other, lesser-known official measure of economic growth, known as gross domestic income, simultaneously climbed at a 1.4% rate. US pending home sales fell in July for the 6th time this year, to the lowest level since the start of the pandemic, extending the housing market's sharp downturn as high borrowing costs sidelined prospective buyers. And separate data showed sales of new homes fell in July for the 6th time this year, to the lowest pace since early 2016. Ideas that were once unthinkable are in fact starting to gain traction among experts looking as to how to solve the UK's energy crisis. Suggestions from politicians, former ministers, energy analysts and economists echoing the solutions of the 1970s include nationalising the industry, fixing prices, rigging wholesale energy markets, and even telling industry to shut down. And then, of course, we have the end of cheap money. Soaring energy prices and crippling inflation means a recession is on the horizon. For the UK housing market, That toxic mix is fueling concerns that a sharp correction is already on its way. And Taiwan's export orders unexpectedly contracted in July as demand from Chinese customers plunged, and officials are now warning of further declines to come. A 22.6% decline in orders from China and Hong Kong, which combined are the second largest source of demand after the US, was the main driver of the surprise fall, according to ministry data. And China's property market crisis is testing whether central bank governor Yi Gang can stick to his stimulus-light strategy. Yi has recently promised monetary policy will remain accommodative to support the economy, but there's an implied limit on how far the PBOC will go. And Australian households are among the most indebted in the world, and so our rapid-fire interest rate increases are sending tremors through the nation's heavily indebted housing sector and could threaten a property downturn on a scale unseen since the eve of the 1991 recession. Indeed, our latest stress results show a horrible spike in mortgage stress. More about that in a few days. Emerging markets like Brazil posted its biggest mid-month decline in consumer prices on record, in a drop that was smaller than analysts expected, as President Jair Bolsonaro's anti-inflation measures provided some relief ahead of the elections, and central banks across sub-Saharan Africa would likely have to remain focused on reining in price growth in the coming months, with economists raising their inflation forecasts in many of the region's key economies. Countries including Ghana, Nigeria, South Africa and Kenya will see higher inflation than previously forecast this year. And Israel's central bank surprised most economists by delivering its biggest increase to interest rates in 2 decades, and Iceland also hiked rates by 75 basis points, while Botswana opted for 50. And officials in Paraguay, Indonesia and Korea went for a 25 basis point increase. China is the largest market for exports and imports through the UK port of Felixstowe, where about 2,000 dockers began an 8-day walkout on Sunday, halting the flow of goods through the UK's largest gateway for containerised imports and exports. And shipping lines plan to reroute cargo around the picketed lines, adding time and cost. So in summary, economic activity weakened from the US to Europe and Asia, reinforcing concerns that soaring prices and the war in Ukraine will tip the world into a recession. And yet the heads of the Bank of England, the Swiss National Bank, the Bank of Japan, the Bank of Korea, and several European central bank policymakers all spoke on Saturday at the Kansas City Fed's annual retreat in the Grand Teton National Park in Wyoming. Their statements followed remarks by Fed Chair Jerome Powell from Friday that sought to unequivocally commit the US central bank to raising interest rates until inflation meaningfully slows. I reported on that yesterday, of course. Policymakers in Europe and in the US are battling the hottest inflation in decades and are resolutely raising rates and push back against suggestions that they will waver if their economies falter while price pressure remains too high. The gathering at Jackson Hole, the first in person since the pandemic spread in 2020, was a platform to convince investors that they would follow through even if it caused pain. ECB Executive Board member Isabel Schnabel, the day's most anticipated speaker, urged her colleagues to act with determination to slow price increases that in Europe are nearing 10% and in the US are above 8%. Both the likelihood and the cost of current high inflation becoming entrenched in expectations are uncomfortably high, she said. In this environment, central banks need to act forcefully. They need to lean with determination against the risk of people starting to doubt the long-term stability of our fiat currencies. And she also acknowledged that there was a risk of recession, but told her fellow policymakers that even if we enter a recession, we have basically little choice than to continue our normalization path, chiming with Powell's remarks the day before that reducing inflation is likely to require a sustained period of below-trend growth. ECB officials are debating what size of interest rate increases may be appropriate at their September meeting, with some arguing that a 75 basis point increase should at least be part of the discussion. The Governing Council in July raised rates by half a percentage point. An ECB Governing Council member, Francois Villeroy de Graal, speaking on the same panel as Schnabel, said that policymakers must be determined in tackling record inflation to avoid being forced into unnecessarily brutal interest rate moves later on. Well, I would argue that the ones so far have been pretty brutal, frankly. There was also discussion about how long high inflation may persist. Swiss National Bank President Thomas Jordan said that structural factors in the economy may contribute to persistently high inflation for years to come, and that it's becoming more broad-based. There are signs that inflation is increasingly spreading to goods and services that are not directly affected by the pandemic or the war in Ukraine, he cautioned. And other unelected central planners made the same points. Jita Gopinath, the first deputy managing director of the International Monetary Fund, said US inflation will persist for at least another year or two. And Augustin Canstains, head of the Bank for International Settlements, warned that the global economy risks sustained weakness if monetary policymakers don't work with governments to revitalise the supply issues that are likely to keep pushing up inflation. Central banks cannot hope to smooth out all economic air pockets and must instead focus first and foremost on keeping inflation low and stable, he said. Monetary policy needs to meet the urgent challenge of dealing with the current inflation threat. Central bankers also expressed the need to communicate more clearly and simply. The sentiment was evident in Powell's speech, which at 5 pages was significantly shorter than in previous years. ECB Governing Council member Joachim Nagel said policymakers sometimes overly complicated the message. The story is pretty clear. Inflation is much too high, and so the answer in a situation like this is also obvious. This is what central banks have to do in a situation like that. We have to raise rates, the head of the German Bundesbank said on Saturday. Complicated is maybe when we will stop, or when is the time coming when we have to stop, he said from the audience. And I have to say, I don't really know. It's much too early to think about where is the more or less likely terminal rate. And colleagues from Asia shared an update from their region. The Bank of Korea governor, who is also fighting inflation and presided over a 25 basis point rate increase last week, said there's a significant chance that Korea and other Asian emerging economies will return to the low inflation and growth environment that dominated the pre-pandemic period. On the other hand, the Bank of Japan governor detailed an economic situation in his country that is very different from what Europe and the US are experiencing. Somewhat miraculously, now we have a 2.4% level of inflation, but almost wholly caused by the international commodity price hike. Energy and food, he said. Inflation will turn lower in his country later this year and next, he said, so we have no choice other than continue monetary easing until wages and prices rise in a stable and sustainable manner. But here's the rub. The Federal Reserve won't be able to curb inflationary pressures because they're rooted in expansionary fiscal policy, according to a paper presented at the Central Bankers' annual Jackson Hole Conference. The fact that approximately half of the recent increase in inflation has fiscal roots poses some significant challenges for policymakers today, they said. Not only fiscal inflation tends to be highly persistent, but it also requires a different policy response. The paper's authors, Francesco Binasci of the Johns Hopkins University and Leonardo Melosi of the Chicago Fed wrote, the US Central Bank began raising interest rates in March, and many officials have since said they were too slow to begin doing so. Now, they said that beginning to tighten sooner would not have made much difference for inflation. However, when inflation has a fiscal nature, monetary policy alone may not provide an effective response. To show this, we ask whether tightening monetary policy earlier on could have prevented the post-pandemic increase in US inflation, they wrote. The increase in rates would have resulted in only a modest reduction in inflation at the cost of a large reduction in output. This large sacrifice ratio arises because when inflation has a fiscal nature, the central bank is not uniquely responsible for its reduction. So the point of all this is to say that central banks are now running to lift rates and lift rates hard, and that will have a significant impact on real households and real businesses. But will it really get inflation under control if indeed inflation has been created by government fiscal measures partly, which I think is true, as well as the disrupted supply chains globally? And if they are going to continue to lift interest rates until such time as inflation is crushed, then inflation will drive interest rates significantly higher. The risk of recession is huge, and of course the impact on real mortgage holders and businesses who are borrowing will be very profound, to say nothing of the very high debts that governments are sitting on thanks to their fiscal stimulus programs through COVID. In other words, government debt will suddenly be very expensive. So I come away from all this thinking, well, they're now chasing the interest rate lever, when in fact the true situation is way more complex. And trying to convince the markets in this environment that in fact rates will go higher could be successful and crash the markets too, but they may not be able to get inflation under control. And to that end, I come back to my central question. How accountable are central bankers and central banks when they get it wrong, as they've been getting it wrong for at least the last 20 years? And isn't it time we gave up on this top-down central planning philosophy, which frankly is doing nobody any good? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.